All right, so let's talk about the #1 tax reduction strategy in real estate, cost segregation studies. Specifically, what is it? Why are people using it? And most importantly, how can it save you thousands of dollars in taxes? My name is Sherman the CPA, and I tax plan for real estate investors and business owners every single day at mycpacoach.com. Today, I'm going to fully explain the concept of cost segregation, how it works, and how you can maximize your tax deductions with it, and something called bonus depreciation. Let's begin. All right, so what is a cost segregation study? In short, it is a study that allows you to take more depreciation expense on your real estate properties. More depreciation means less income reported on your tax return, and less income on your tax return means lower taxes. Now remember, depreciation is a non-cash expense that you can take that does not cost you any money out of your pocket. The IRS allows you to take this magical expense as a tax deduction each year to quote, to allow you to recover the cost of the property over the time that you use it. And a cost segregation study simply allows you to take more of that depreciation. For example, residential rental property is depreciated over 27.5 years by default, which means your depreciation expense will be equal to your purchase price divided by 27.5 years. However, things inside of the property like furniture, carpets, fixtures, and appliances, and so on, may be depreciated over 5 to 15 years, which would effectively increase your depreciation expense. But you can only depreciate the value of those components with a cost segregation study. With this, you are doing exactly what the name implies. You are segregating the cost of the asset by the different components inside of it, and therefore are taking advantage of shorter depreciation periods. Now, without a cost segregation study, you would only be able to spread the cost of those components over the total useful life of the property, which would be 27.5 years. So even though your property may have fans, fixtures, appliances, and other things that may really only last 5 to 7 years, you would only get the tax benefit of it over 27.5 years. Here is a simple example of how a cost segregation study works. Let's say you purchase rental property for $500,000 and you have carpets, stoves, refrigerators, furniture, and other fixtures or appliances on your property that are worth $150,000. Well, if you depreciate this over 27.5 years, you would have a $5,500 depreciation deduction in the first year. But if you depreciated this over 5 years with a cost segregation study, you would have a $30,000 deduction, which is almost 6 times the deduction you would have originally had. And if you are in the top tax bracket of 37%, then this would save you over $10,000 in taxes. But wait, this gets even better with bonus depreciation. This is another huge tax benefit associated with cost segregation studies that we have not addressed yet. So what if I told you that instead of depreciating components of your property over 5, 7, or 15 years, you could depreciate even more of it in year 1? Well, you can with bonus depreciation. Bonus depreciation allows you to deduct a larger portion of short-lived property. According to Section 168 of the Internal Revenue Code, this is defined as property with a recovery period or useful life of 20 years or less. And since the cost segregation study identifies components that have 5 to 15-year useful lives, then it would effectively identify property that is eligible for bonus depreciation. So let's go back to our example to illustrate the impact of bonus depreciation with a cost seg study. So remember, we had $150,000 of short-term components valued on the property. Our standard depreciation deduction was about $5,500 if we divided that amount by 27.5 years. Now, the cost seg study would allow us to deduct $30,000 by spreading the cost over 5 years instead of 27. And bonus depreciation would allow us to deduct $120,000 by taking 80% of the cost as depreciation in year one. This deduction would save you almost $45,000 in taxes if you are in the top tax bracket. And it takes no work on your part other than getting a cost segregation study conducted. Now, when it comes to cost segregation studies and using this tax strategy, there are 4 big things that you need to be aware of. Number 1, bonus depreciation fluctuates. Over the last 20 years, bonus depreciation has fluctuated from 30% to 100%. Now in 2022, bonus depreciation was 100%. In 2023, it is 80%. And over the next few years, it will continue to drop by 20% until it technically does not exist anymore. However, based on history, I'm pretty sure that it will come back up again depending on the politician we have in office. Number 2, rental losses. When you take large amounts of depreciation on your properties, it normally exceeds the income generated from the property. Therefore, you can typically expect a loss on your tax return due to depreciation, which is good because number 1, you won't pay any tax on the cash flow from your rental that year. And then number 2, you can apply the excess losses against other types of income you earn. Number 3, real estate income is passive, which is important because passive losses can only offset passive income unless you are a real estate professional. If you qualify as a real estate professional, then you can apply your rental losses against your earned income, which may include income from your W-2 or business, for example. Now, there are several ways to qualify as a real estate professional, and that is beyond the scope of this video, unfortunately. But if you want an in-depth video on that subject, subscribe and drop a comment below requesting it. Number 4, depreciation recaptured. So when you take depreciation on your rental properties, it lowers your cost basis. And when you sell the property, you would have to recapture the depreciation you took, which may result in more taxes if you are not careful. For example, let's say you bought a property for $200,000 and depreciated it down to $0. Then you decide to sell it in the future for $300,000. Well, instead of paying capital gains tax on the difference of your purchase price of $200,000 and sales price of $300,000, you would instead pay capital gains tax on the difference between your new cost basis of $0 and your sales price of $300K. So instead of having a $100,000 capital gain, you would have a $300,000 capital gain, and that surprises some people. But fortunately, there are ways to get around this with tax strategies like the 1031 exchange or deferred sales trust, which we'll talk more about on this channel, so make sure you subscribe. All right, so since you made it this far in the video, I want to go ahead and give you a bonus tip, and that is disclosing the name of the vendor I use for all of my clients' cost segregation studies that can conduct a virtual cost seg study for you in any part of the US. And that vendor is linked in the description of this video. So check it out and get in contact with them if you are seriously interested in receiving a cost segregation study. But remember, it is important to have a plan in place that helps you put that cost seg study to good use. I have a client right now with hundreds of thousands of dollars in passive losses that he cannot use because he has no passive income to apply those losses against. To prevent mistakes like this, do yourself a favor and get an experienced tax professional involved who can guide you through strategies like this based on your unique set of circumstances. And if that's something you're interested in, then apply to become an exclusive client of mine today at mycpacoach.com. As always, thank you for watching, and we look forward to seeing you in the next episode.